Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our periodic commentary on market and economic events. Let's get started. This Market Insights is dedicated to our outlook for 2023. And I really wish that we had better news for investors. But if you've been following our work for the last 20 years, you know that our number one mantra when it comes to setting short-term market strategy is don't fight the Fed. And that guidance served us really well last year. Our outlook correctly forecast a tough year for investors because we felt very strongly that escalating inflation was going to force the Fed to tighten, and the markets were overvalued more than at any time since the 90s tech bubble. Combine a tightening Fed and an overvalued market, and bad things happen for investors. But I think if you were to cast back to a year ago and you said, do you think the bad times would carry over into 2023? Would have probably said no. The economy was extremely well positioned to accommodate a Fed tightening. Consumer balance sheets are really strong. And we also felt that inflation wasn't an endemic problem. It had been caused because the Fed printed trillions of dollars to finance President Trump and President Biden's deficits. If they cut off the printing press, then that starves the economy of inflation, and we felt like inflation could quickly come down. Now, we ran into a roadblock on that optimistic forecast for 2023 when the Vladimir Putin invaded Ukraine. That delayed the drop in inflation that we were expecting, but if you look around, it didn't deny it. You've got oil back to pre-invasion levels, commodity prices have been collapsing, and very clearly, in our opinion, now that money supply has dropped from 25% growth to shrinking at -1 to 2%. It's the first time that money supply as measured by M2 has ever shrunk. Even back in the Volcker days, they didn't have to shrink money supply to crack inflation. Now that that's all happening, you're seeing wage gains starting to roll over and come down to a more reasonable level. All the good stuff that we thought would be happening by the end of 2022, rolling into 2023, seems to be still happening. It just kind of got pushed out in time because of the inflationary consequences of the war. So why is our outlook titled An Unnecessary Recession? Why are we suggesting that in a worst case, investors might have to prepare for another 15 or 20% decline? And the answer lies in that mantra, don't fight the Fed. And all the good things that we are seeing in the inflationary news, the Fed is considering transitory. And if there were ever a word that I would have expunged from the Fed vocabulary, it would be transitory, since that's what they called inflation on the way up. Oh, it'll pass. Well, now they're using that same term to saying that the good news might pass and we could see another spike in inflation coming from, I don't know, Mars or something. The issue is that the Fed has a single-minded focus on unemployment as a measure of whether they are actually getting on top of inflation. They don't believe in the money supply as the primary driver of inflation. And because of that, they're looking at indicators that didn't help them predict that inflation was getting out of control on the way up, and yet they're continuing to rely on those indicators on the way down. And it's causing them to overestimate inflationary pressures, in our opinion, and tighten beyond the point at which the economy needs tightening. So what will that mean? Well, the Federal Reserve in their December minutes from their meeting made it very, very clear that they are determined to keep tightening. And they're actually worried that financial markets aren't taking them seriously. That financial markets are kind of looking at the indicators that we're looking at and saying the inflation picture is getting way better. The Fed's going to have to shut down their tightening process sometime soon. The Fed explicitly addressed that in their December minutes and said, you better take us seriously. We're going to keep tightening. We're going to wreck this economy and make sure that millions of Americans lose their job. Well, they didn't say that directly, but I think you can infer it from the language that they used. And it's all the more alarming that we are starting 2023 with the market ignoring those messages from the Fed. We're trying to rally, and every rally in the past has made the Fed more determined to tighten more aggressively. And again, we'll go back. Why? They don't really want to destroy the economy, but they are focused on backward-looking measures of inflation like the CPI housing measure and unemployment, which has historically had no correlation to future inflation. As long as they're focusing on those two measures as a big part of their inflationary gauge, unemployment isn't budging because consumers are in good shape. The COVID stimulus way overdid it, and it allowed consumers to accumulate over $2 trillion in excess savings. Even as the economy slows and the job market gets tougher, they're just spending down those savings to support consumer spending. That's why the economy hasn't collapsed the way the Fed hoped it would. And they've got enough savings to continue supporting the economy throughout 2023. That should be good. That should be something that we draw encouragement from. But unfortunately, if the Fed is going to keep looking at inflation being driven by unemployment, and if unemployment isn't going to rise as fast as they want it to because of that war chest of consumer savings, that means more tightening, and when the savings run dry, a deeper problem for the U.S. recession, for the U.S. economy. One last thing, housing markets. Housing markets are clearly rolling over. Rents are falling across the country. Case-Shiller price indices are falling, but the Fed is looking at CPI in housing data, which is statistically lagged about a year. So they're seeing the inflation from a year ago. And this is the exact measure that caused them to underestimate inflationary pressures, because market measures were hitting 25-30% of housing inflation, and they're looking at a lagged indicator that says it's 3%. Now the lagged indicator is up at 10-12, but it's from a year ago. And meanwhile, the market indicators are going negative. So again, the Fed's focused on the wrong indicators. That's causing them to stay on a tightening track longer than the economy needs. And that means that the market's still overvalued based upon our indicators. It's still about 15 to 20% overvalued. Now, markets can stay overvalued for long periods of time. They typically don't go back to fair value or get cheap until you have a recession. It looks like to us that right now the Fed's on track to put us into a recession. That would cause the market to need to drop another 15 to 20% to get back to fair value. Is there any hope in this gloomy outlook? Sure there is. There are increasing voices at the Fed that are saying the exact same things that we're saying. You're overdoing it. You're looking at the wrong indicators. We need to stop tightening and give a pause and see the cumulative effect of what we've already done. Those voices are being overshadowed for the moment. But if inflation numbers keep coming down, if they come down fast enough, maybe those voices can get some added support and bring Powell back to his senses. Now, we can't say that's the main outlook, because if you read what the decision makers are saying, they're not prepared to accept that more benign view. They want to tighten and tighten and tighten until unemployment goes up a lot. All right? So this is a glimmer of hope, but that glimmer of hope requires some really good news coming out of the inflation numbers in the next few months. We are very comfortable that inflation is going to be down a lot by the end of the year, but will it be down by March, April, enough to convince the hawks at the Fed that they need to switch over to the dovish side? That's a tough call. And it's going to be a tough sell based upon the language that the FOMC members are using to describe how firmly they are committed to a tightening path. So for right now, we have to say, don't fight the Fed. Expect more turbulence in equity markets. And if you're looking for a safe haven, bonds are now at yields that offer good long-term returns for the first time in 15 years and a credible hedge to turbulence in the equity markets. We also believe that some of the factor-based indices that have been overlooked in the run-up of the last 2 or 3 years, and they are back to fair value, things like dividend stocks, low vol, they are also a potential safe haven in what could be another very tough year. Thank you for joining us for Market Insights. We hope you found it informative. If you did, we hope you can like it and share it with your friends. Also, if you want to see our full outlook and a more in-depth discussion on some of the problems with the Fed's indicators and the kind of indicators we use to successfully forecast inflation starting back in 2020, then please check out our outlook for 2023, An Unnecessary Recession, and you can find more details there.